morning, everyone. I am Deepankan Khatua is going to make a presentation through the ICAPITAL Academy. First of all, I would like to thank Sivraj sir and Amit sir for providing me with this opportunity to empower my growth through competitive knowledge. I hereby grant permission to iCapital Academy and Corporate Advisory LLP to use the video presentation, PPT, assessment test, and MCQs created or provided by me for educational or promotional purposes. This includes publishing or sharing the content on their social media platforms, website, or through any other medium they deem appropriate. I confirm that I have no objection to such use. I am going to make a presentation on the topic credit risk management in banking and financial markets. First of all, credit risk is defined as the potential financial loss a bank faces when a borrower or counterparty fails to meet contractual obligations, such as repaying the principal or interest on a loan. This risk is central to banking as defaults can erode profits, deplete capital reserves, and damage a bank's reputation. It's especially critical in retail lending, for example, mortgages, credit cards, and SME, small and medium enterprise lending, where the borrower profiles vary widely. Understanding credit risk is the foundation for effective risk management, ensuring banks remain solvent and stable in volatile markets. This slide introduces the concept to set the stage for deeper analysis, having definition, impact and relevance and goal of credit risk. Scope of the project. This project examines credit risk management with a specific focus on retail lending, which includes mortgages, credit cards, and personal loans, and SME lending, which involves loans to small and medium enterprises critical for economic growth. The analysis covers three key areas: measurement using models like probability of default and expected loss, monitoring through tools like stress testing and early warning systems, and mitigation via strategies such as collateral and diversification. Regulatory frameworks, including Basel norms and recent trends such as artificial intelligence in risk assessment, are also explored. The goal is to provide a holistic view of how banks manage credit risk. Objectives. The objectives of this project are clear and targeted. First, we aim to understand the nature and types of credit risk, such as default and concentration risks, and their impacts on the banking and financial markets. Second, we explore measurement tools, including probability of default, loss given default, and exposure at default, to quantify the risk accurately. Third, we analyze mitigation strategies such as collateral, credit derivatives, and loan covenants to reduce the potential losses. Finally, we highlight the lessons from historical events like the 2008 financial crisis and incorporate recent data to provide current insights. These objectives guide the presentation and project deliverables. Relevance of credit risk. Credit risk is a cornerstone of banking, directly affecting profitability by reducing income from loan defaults, depleting capital reserves needed for stability, and harming reputation if mismanaged. The 2008 financial crisis demonstrated this, where poor credit risk practices in subprime mortgages led to billions in losses, bank failures, and a global recession. Today, economic volatility, such as inflation, rising interest rates, and geopolitical tensions, heightens the need for robust risk management. For retail and SME lending, where borrowers range from individuals to small businesses, effective credit risk strategies are vital to ensure financial stability and support economic growth. Global non-performing loans trends. These are the loans overdue by 90 days or more, a key indicator of credit risk. According to the International Monetary Fund, the global NPL ratio was 3.5% in 2023, reflecting post-COVID recovery challenges. This improved slightly to 3.3% in 2024 as economies stabilized, as per IMF reports. Projections for Q1 2025 estimate a global NPL ratio of 3.2%, driven by ongoing inflation and interest rate pressures. These trends underscore the need for vigilant risk management as high NPLs signal potential losses and strain on bank balance sheets worldwide. Retail lending. Retail lending encompassing mortgages, credit cards, and personal loans faces significant credit risk. The Mortgage Bankers Association reports a US mortgage delinquency rate of 2.5% in the first quarter of 2025. This reflects the borrowers struggling with higher rates. The Federal Reserve notes a credit card default of 4.1% in the first quarter of 2025, elevated due to rising living costs and unsecured debt. These increases are tied to economic pressures, including inflation, for example, 3% in 2025, and critical bank rate hikes. Effective risk management is crucial to curb the defaults and protect bank profitability in this high volume sector. Small and medium enterprises are vital for economic growth, but pose unique credit risk due to volatile cash flows and limited collateral. The European Central Bank reports an SME NPL rate of 5.2% in 2024, higher than retail due to business vulnerabilities. In the United States, the delinquency reached 4.8% in the first quarter of 2025, as per the Federal Reserve, driven by supply chain issues and inflation. Despite risks, SME lending grew 10% annually from 2023 to 2025, as per the World Bank, as banks support entrepreneurship. Managing this risk is key to global growth and stability. This presentation is organized into 8 sections. The first section introduces credit risk and its importance. Second section explores the types of credit risk, such as default and concentration. The third covers measurement using models like PD and LGD. Fourth examines monitoring techniques, including stress testing, early warning systems. Fifth one details mitigation strategies, such as collateral and diversification. Section 6 analyzes regulatory frameworks, such as Basel norms. Section 7 reviews case studies and recent trends, including the 2008 crisis and artificial intelligence. This project addresses the critical questions to guide our analysis. First, how is credit risk measured in banking? We will all explore models like probability of default and expected loss. Second, what tools and models are effective for the assessment? We will examine credit scoring, stress testing, and more. Third, how do banks monitor and mitigate credit risk? We'll cover early warning systems, collateral, and derivatives. Finally, what lessons can we learn from the past crisis and recent data? The 2008 crisis and 2025 trends provide insights. These questions drive our exploration of credit risk management. Credit risk manifests in various forms, each posing unique challenges to the banks. This section focuses on 3 primary types: default risk, where borrowers fail to repay; concentration risk, from overexposure to a single entity or sector; and portfolio risk, where correlated defaults impact a loan pool. We'll explore these in the context of retail lending, such as mortgages and credit cards, and SME lending, where businesses face distinct risks. Understanding these types is essential for tailoring measurement and mitigation strategies to protect the banks from losses and ensuring stability. Default risk. Default risk is the possibility that a borrower or counterparty fails to pay the interest or the principal on a loan as agreed. It is a core concern in banking, prevalent in retail lending, such as mortgages and credit cards, where individuals may miss payments, and in SME lending, where businesses face cash flow issues. When a default occurs, banks face direct financial losses, reduced profitability, and potential strain on capital reserves. This risk is the starting point for credit risk management, requiring robust assessment and monitoring to minimize the impact. Let's take an example. A notable example of default risk is the wave of subprime mortgage defaults during the 2008 financial crisis. Subprime borrowers, often with low credit scores, for example below 620, received high-risk mortgages with adjustable rates. When the rates rose and housing prices fell, many defaulted, unable to repay. This led to over $1 trillion in losses for the US banks, triggering foreclosures and bank failures. This example highlights the dangers of lax credit standards and the need for careful risk assessment in retail lending. Recent data underscores ongoing default risk challenges. The Mortgage Bankers Association reports a US mortgage delinquency rate of 2.5% in the first quarter of 2025, reflecting borrowers struggling with higher interest rates. The Federal Reserve notes a credit card delinquency rate of 4.1% in the first quarter of 2025, which is driven by rising costs and unsecured debt. These trends are tied to economic pressures such as inflation, 3% in 2025, and central bank rate hikes. This data highlights the need for proactive risk management to curb defaults in the retail lending. The second one is concentration risk. It arises when a bank has excessive exposure to a single borrower, sector, or a geographic region. For example, lending too much to one SME or the real estate sector increases vulnerability. If that borrower or sector fails, losses can be significant, amplifying the financial strains. This risk is critical in both retail and SME lending, where over-reliance on a single area can destabilize a bank's portfolio. Managing concentration risk requires diversification and strict exposure limits to protect against large-scale defaults. Let's take an example. A classic example of concentration risk occurred before the 2008 financial crisis when banks heavily invested in the real estate loans. Some US banks had over 50% of their portfolios in mortgages and related securities. When the housing market crashed in 2007-2008, defaults surged, leading to massive losses and bank failures. For example, the Lehman Brothers. This case underscores the danger of overexposure and the lesson that diversifying loan portfolios across sectors and borrowers is critical to reducing concentration risk and ensuring stability. Recent data highlights the ongoing concentration risks. In 2024, some banks had SME loan exposure reaching 25% of Tier 1 capital as per bank reports, nearing regulatory limits. Basel norms often cap exposure to a single sector or borrower at 25% of Tier 1 capital to limit the risk. Trends show banks reducing concentration by diversifying into retail, tech, and other sectors with a 5% shift noted in 2024. This is BIS data. This adjustment helps mitigate losses if one area underperforms, reflecting post-crisis lessons. The third one is portfolio risk. It refers to the potential for losses across a bank's entire loan portfolio due to correlated defaults. When many borrowers default simultaneously, often triggered by economic downturns, industry slumps, or recessions, the impact is amplified. This risk is relevant for retail loans like mortgages and credit cards, and SME loans, where businesses fail together in a crisis. Managing portfolio risk requires understanding correlations and diversifying to limit the ripple effect of defaults across the loan book. An example of portfolio risk emerged during the COVID-19 pandemic 2020 to 2021. SME loan portfolios faced correlated defaults as businesses in retail, hospitality, and travel shut down due to lockdowns. In the European Union, SME lending non-performing loans spiked to 6% in 2021 as per the European Central Bank as revenues collapsed. This wave of defaults strained bank balance sheets, highlighting the need for portfolio diversification and stress testing to anticipate and manage correlated risks in economic downturns. Recent data reveals portfolio risk dynamics. The Bank for International Settlements reports a correlation of defaults in retail loans at 0.3% in 2024, meaning defaults are moderately linked. SME portfolio risk is higher due to economic volatility, with NPLs at 3.3% globally in 2024, as per the IMF. This reflects vulnerabilities to inflation and supply chain disruptions. Banks are countering this by analyzing correlations and diversifying portfolios to reduce the impact of simultaneous defaults. Retail lending includes mortgages, credit cards, personal loans, serving millions of individual borrowers. This sector is high volume with diverse risk profiles, from stable homeowners to risky credit card users. Defaults are influenced by economic factors like unemployment, rising interest rates, and inflation, which reduce borrowers' ability to pay. Understanding these risks is critical as retail loans form a large part of bank portfolios and mismanagement can lead to significant losses and instability. Retail lending risks vary by loan type. For mortgages, defaults rise when interest rates increase, making payments unaffordable. For example, adjustable rate mortgages in 2008. Credit cards being unsecured have high default risk, especially during economic stress. Personal loans are vulnerable to income loss, such as job cuts, leaving borrowers unable to repay. These examples show how economic conditions and loan characteristics drive risk, requiring careful assessment and monitoring by the banks. Recent data highlights retail lending risks. The Mortgage Bankers Association reports a US mortgage delinquency rate of 2.5% in first quarter of 2025, reflecting rate hike pressures. The Federal Reserve note a credit card default rate of 4.1% in first quarter of 2025, driven by rising cost and unsecured debt. Personal loan NPLs reached 3.8% in 2024 as per the BIS, which was tied to economic uncertainty. These figures emphasize the need for robust risk management in retail lending. Small and medium enterprises are crucial for economic growth, employing millions and driving innovation. However, lending to SMEs carries unique risks. Limited collateral, as many lack assets to secure loans, and volatile cash flows due to market or seasonal fluctuations. These risks peak during economic downturns when SMEs struggle to survive. Banks must balance supporting SMEs with managing credit risk, making this a critical area for tailored strategies and close monitoring. Data underscores SME lending risk. The European Central Bank reports an SME NPL rate of 5.2% in 2024, higher than retail due to business challenges. In the United States, the SME delinquency hit 4.8% in the first quarter of 2025, as per the Federal Reserve, which was driven by inflation and supply chain disruptions. These trends highlight rising risk with economic pressures like 3% inflation and global trade issues impacting the SMEs. Banks need proactive measures to manage this volatile sector. Measuring credit risk is essential for the banks to quantify the potential losses and make informed lending decisions. This section explores two approaches: quantitative, using mathematical models like probability of default and expected loss, Second one is qualitative, relying on judgment, such as assessing a borrower's character. We focus on models for retail lending, mortgages, credit cards, and SME lending, where risk profiles differ. Accurate measurement guides loan approvals, pricing, and capital planning, ensuring banks manage risk effectively. Credit scoring models. Credit scoring models assign a numerical score to assess a borrower's creditworthiness, predicting their likelihood of repaying a loan. These models are widely used in retail lending, such as the FICO score for mortgages and credit card, and adapted for SMEs to evaluate business viability. By analyzing the financial history, debt levels, and other factors, banks determine risk levels, approve loans, and set the interest rates. Credit scoring is the cornerstone of credit risk measurement, offering a fast, standardized approach to decision making. The FICO score, a lending credit scoring model, is critical for retail lending in the United States and beyond. It's calculated using a formula. FICO score equals 35% payment history, timely payments, plus 30% amounts owed, debt levels, plus 15% of length of credit history, account age, plus 10% new credit, recent inquiries, plus 10% of credit mix, variety of accounts. Scores range from 300 to 850, with higher scores indicating lower risk. Banks use this to approve mortgages, credit cards, and more, setting terms based on the risk. Let us take an example of the FICO model. Let us consider two retail borrowers. Borrower A has a strong record, timely payments, low debt, and a long credit history, yielding a FICO score of 720, which is classified as low risk. This qualifies them for a mortgage at a 4% interest rate. Borrower B, however, has missed payments and high debt, resulting in a FICO score of 580, a high risk profile. They may be denied or face a 6% rate. This example shows how FICO scores guide lending decisions and balancing risk and rewards for the banks. SME scoring. For SMEs, credit scoring accesses business creditworthiness, as traditional FICO scores don't fully apply. Factors include cash flow, revenue stability, debt ratio, debt to income, business age, years operating, and industry risk. For example, retail versus tech. A typical model might score an SME from 0 to 100, where 70 out of 100 indicates a moderate risk. Banks use this to evaluate loan applications, set terms, and monitor risk. SME scoring is vital for lending to businesses with limited credit history or volatile finances. Recent data highlights credit scoring trends. The average US FICO score is 715 in 2025, reflecting a stable consumer credit. For SMEs, 60% of businesses score between 60 and 80 on a 100-point scale, as per the 2024 BIS data, indicating a moderate risk. A trend shows artificial intelligence improving scoring accuracy by analyzing alternative data like transactions and social media. This data underscores the widespread use of scoring in retail and SME lending, driving a better risk assessment. Credit scoring models offer key advantages to the banks. They provide fast, automated risk assessment, processing applications in minutes. They reduce human bias by relying on data, not subjective judgment, thus ensuring fairer decisions. For retail and SMEs, scoring enables quick loan approvals, improving customer experience and operational efficiency. These benefits make credit scoring a vital tool, streamlining lending while maintaining rigor in credit risk management across diverse portfolios. Let us delve into limitations of credit scoring models. Despite the benefits, credit scoring has limitations. Models rely on historical data, which may miss new risks like sudden economic shifts. For SMEs, new businesses with no credit history are hard to score, thus increasing the uncertainty. Data quality is critical. Inaccurate or incomplete inputs lead to flawed scores. Banks must address these limits by combining scoring with other tools and updating models to reflect the current conditions, ensuring a reliable risk assessment. Artificial intelligence is transforming credit scoring by incorporating alternative data such as transaction histories, social media activity, and utility payments. This enhances accuracy, especially for the borrowers with thin credit files like new SMEs. AI models adapt in real time, improving predictions of default risk. Data from the BIS shows that 65% of banks use artificial intelligence for credit scoring in 2025. This reflects a shift towards advanced data-driven risk assessment in retail and SME lending. Let us take an example of credit scoring models. For instance, if a bank uses an AI-based model to score an SME applying for a $50,000 loan, inputs include low cash flow, down to 10% yearly, and a short business history, 2 years, yielding a score of 55 upon 100, indicating moderate to high risk. The bank responds by offering a higher interest rate, for example, 7%, or denying the loan. This example shows how artificial intelligence scoring detects the risk early, thus allowing the banks to adjust the terms and protect against potential defaults in the SME lending. Probability of default. Probability of default is the likelihood that a borrower will fail to repay a loan within a specific period, typically within 1 year. It's a key metric in Basel frameworks used to assess risk in retail lending, for example, mortgages, credit cards, and SME loans. PD quantifies the chance of default, helping banks set interest rates, approve loans, and estimate potential losses. Accurate probability of default calculation is critical for effective credit risk management and regulatory compliance. Probability of default is often calculated using a logistic regression model. PD is equal to 1 by 1 plus e to the power minus b naught beta naught plus beta 1 x1 plus beta 2 x2 until beta n xn, where beta naught is the intercept, a constant base value, beta I are coefficients weighing each factor, and xi are variables such as income, debt, or credit history. This formula estimates the probability of default, converting the inputs into a percentage. The banks use this to assess risk, with higher PD signaling greater likelihood of non-payment. PD models rely on specific variables. For retail lending, key inputs include income, monthly earnings, credit score, for example, FICO, and debt to income ratio, that is debt versus earnings. For SMEs, Variables are revenue, annual sales, cash flow, liquidity, and industry risk. For example, volatile sectors like the retail. Each variable is weighed by coefficients based on its impact. These inputs allow banks to tailor PD models to borrower profiles, thus improving the risk prediction accuracy. Let us take an example to understand this better. Consider an SME applying for a $1 lakh loan. The inputs are low revenue down to 5%, x1 is equal to -1, high debt, x2 is equal to 1. The model uses beta naught -2 intercept and beta 1 0.5, which is revenue coefficient, and beta 2 is 1.2, which is the debt coefficient. Upon calculation, the PD comes out 2% after applying the formula. This 2% probability of default indicates low to moderate risk, thus guiding the bank's decision. Recent data shows the new PD trends. The BIS reports an average PD of 1.8% for retail loans in 2024, reflecting a stable consumer credit. For SMEs, the ECB notes a higher PD of 3.5% in 2024 due to business volatility. Trends indicate rising PD in 2025, driven by economic uncertainty, such as inflation, which is 3%, and rate hikes. These figures highlight the need for accurate PD models to access and manage credit risk effectively in both the sectors. In retail lending, PD is used to evaluate mortgage, credit card, and personal loan applications. For example, a borrower with a PD of 1% is low risk, likely approved for a mortgage at a 4% rate. A PD above 5% signals high risk, leading to denial or higher rates, for example, 6%. Banks rely on PD to set terms, balance risk, and ensure profitability, making it a vital tool in high volume retail lending operations. For SME lending, the probability of default assesses the business loan risk. An SME with a probability of default of 3% is a moderate risk, prompting the bank to approve a $50,000 loan but require a 6% interest rate or collateral. A higher probability of default, for example 7%, might lead to stricter terms or denial. Probability of default helps the banks to tailor lending decisions, balancing support for SMEs with protection against defaults, especially in volatile economic conditions. Calculating probability of default faces several challenges. Data gaps, such as missing credit history for new borrowers or SMEs, reduce accuracy. Economic shifts, like recessions or rate hikes, alter the risk profiles, making the models outdated. Regular updates are needed to reflect the current conditions, but this requires resources and expertise. Banks must address these issues to ensure PD models remain reliable for credit risk assessment in retail and SME lending. Artificial intelligence enhances probability of default models by analyzing the real-time data, such as cash flows, market trends, and alternative sources. Example, transactions. For SMEs, artificial intelligence adjusts probability of default dynamically, improving accuracy for businesses with a limited history. The BIS reports 60% of banks use artificial intelligence for probability of default in 2025. This reflects a shift to advanced technology. This approach refines risk prediction, thus helping other banks make better lending decisions in the fast-changing environment. Let us take a case. A bank calculates probability of default for an SME seeking a $75,000 loan. The inputs are declining revenue down to 10% and high debt to equity ratio 2:1. This model yields a probability of default of 2.5%, indicating moderate risk. The bank responds by increasing monitoring, requiring monthly financial reports, and setting a 6% interest rate. This case shows how probability of default guides risk management, thus allowing the banks to balance lending with caution in SME financing. Loss given default. The LGD model is the portion of a loan a bank loses if a borrower defaults, expressed as a percentage of exposure. It's a critical metric for estimating potential losses, complementing the probability of default. The loss given default varies by loan type. Secured loans, example mortgages, have lower LGD due to collateral, while unsecured loans, for example credit cards, have higher LGD. Understanding loss given default helps the banks to prepare for losses in retail and SME lending. The LGD is calculated as LGD equals 1 minus recovery rate. Here, the recovery rate is the percentage of the loan amount recovered after a default, such as through collateral sales or through the legal action. For example, if a bank recovers 60% of a defaulted loan, the LGD is 1 minus 60%, that is 1 minus 0.6, which is 0.4, or we can say 40%. This formula quantifies the loss severity, guiding banks in setting reserves and managing the credit risk across loan portfolios. Let us take some examples. LGD varies by loan type. For a mortgage, a secured loan, the bank might recover 80% via property sale. So LGD equals 20%. For a credit card and unsecured loan, the recovery is lower, let's say 60%, yielding an LGD of 40%. For an SME loan, partial collateral, for example, equipment, this might result in 55% recovery. So the LGD becomes 45%. These examples show how collateral impacts the loss given default, and it is critical for retail and SME risk management. The recent data highlights LGD trends. The Basel Committee reports an average LGD of 45% for SME loans in 2024, reflecting partial collateral. For retail unsecured loans, LGD averages 50% in 2024 as per the BIS, which is due to low recovery. Trends show LGD stabilizing as banks improve recovery practices, such as faster asset sales and legal action. This data informs loss provisioning and capital planning in banking. Loss given default is used to estimate potential losses after a default. For example, a $1 lakh SME loan with an LGD of 40% means a potential loss of $40,000 if the borrower defaults. Banks use this to set loan loss provisions, reserving funds to cover the losses and to determine capital needs under the Basel rules. Loss given default helps the banks prepare for worst case scenarios, ensuring financial stability in retail and SME lending. Exposure at default. It is the total amount a bank is exposed to when a borrower defaults, including both the outstanding loan balance and any committed but undrawn amounts such as credit lines. Exposure at default is a key metric for retail loans like credit cards and SME loans, where businesses often have lines of credit. Calculating EAD helps banks access the full scope of risk, thus guiding the lending limits and the risk management strategies. Exposure at default is calculated by the given formula. EAD is equal to outstanding balance plus committed undrawn amount. The outstanding balance is the amount that is already borrowed, while the undrawn amount is the remaining credit available. Let us take an example. For example, a credit line with $6,000 drawn and $4,000 undrawn has an EAD of $10,000, assuming the borrower draws the full amount before default. This formula quantifies total exposure for risk planning. Exposure at default varies by loan type. For a mortgage fully drawn, exposure at default equals $2 lakh, the outstanding balance. For a credit line, $10,000 drawn and $5,000 undrawn, the EAD equals to $15,000, assuming full drawdown. For an SME, a $50,000 loan plus $10,000 undrawn line yields an exposure at default amounting to $60,000. These are the examples which show how exposure at default captures the total risk, which is critical for retail and SME lending decisions. The recent data shows exposure at default trends. The IMF notes rising EAD in retail lending in 2024, which are driven by increased credit card use and higher limits. For SMEs, the EAD grew at 10% annually from 2023 to 2025 per the BIS, reflecting expanded credit lines for businesses. This growth is notable in volatile economies, where borrowers draw more credit, thus increasing the bank exposure. The data guides banks in setting the exposure limits. Exposure at default guides the bank in managing risk exposure. For example, a bank caps exposure at default at $1 million per SME to limit the potential losses. The EAD is used in expected loss models, combining with PD and LGD to estimate the risk. This helps banks set the lending limits, price loans, and ensure capital adequacy, protecting against the large-scale defaults in retail and SME portfolios. Expected loss. Expected loss is the estimated financial loss from credit risk, combining probability of default, loss given default, and exposure at default. It represents the average loss a bank expects over time, critical for retail and SME lending. The expected loss helps the banks set aside loan loss provisions and meet capital requirements, ensuring they can absorb the losses and remain stable. This metric is a cornerstone of credit risk management. The formula for expected loss is EL equal to PD into LGD into EAD. PD, where PD is the probability of default, the likelihood of non-payment. LGD is the loss given default, loss severity, and EAD is the exposure at default. That is the total amount at risk. Let us take an example. A loan with a PD of 2%, LGD of 50%, and EAD of $50,000 has expected loss of $500. This quantifies the expected loss for planning. Let's understand this better with an example. Consider an SME loan of $1 lakh. The bank calculates a PD of 3%, which is moderate default risk, an LGD of 45%, there is partial collateral, and an EAD of $1 lakh, which is fully drawn. Using the formula EL equals to PD multiplied by LGD multiplied by EAD, we get the expected loss as $1,350. This means the bank expects a $1,350 loss on average, guiding the reserves and the risk decisions for this loan. Data highlights expected loss trends. The Federal Reserve reports retail EL across US banks at 2.5 billion in 2024, which reflects high loan volumes. The SME expected loss is higher per loan due to riskier profiles. Trends show expected loss rising with economic uncertainty such as 3% inflation and rate hikes in 2025. This data drives banks to increase provisions and strengthen risk management for retail and SME lending. Expected loss guides the banks in financial planning. For example, an SME loan with expected loss of $1,350 prompts the bank to reserve $1,350 in loan loss provisions to cover the potential defaults. Expected loss also aligns with Basel capital requirements, ensuring banks hold enough capital to absorb the losses. This metric helps the banks manage risk, price loans, and maintain stability in retail and SME portfolios. Monitoring credit risk is vital to detect potential defaults early, before they escalate into significant losses. Regular oversight of borrower behavior, loan performance, and economic conditions allows the bank to intervene with adjustments such as restructuring the loans. This protects bank stability, preserves profitability, and ensures capital adequacy. For retail and SME lending, where the risk shift with economic trends, proactive monitoring is a cornerstone for the effective credit risk management, preventing small issues from becoming crises. Banks track key indicators to spot the credit risk early. These metrics provide insights into borrower health and loan performance. Examples include delinquency rates, which is late payments, debt to income ratios, which is borrower leverage, and payment behavior, the timeliness of the payment. For retail loan, like mortgages and credit cards and SME loans, these indicators reveal warning signs, enabling the banks to act swiftly when needed. Monitoring these metrics is essential for managing risk across diverse portfolios. Delinquency rate measures loans overdue by 30, 60, or 90 plus days, which is a direct sign of credit risk. For retail lending, the Federal Reserve reports a 3.1% delinquency rate in the first quarter of 2025, which is driven by rate hikes and inflation. For SMEs, the delinquency hit 4.8% in the first quarter of 2025, reflecting business struggles. Tracking the delinquency helps the banks to identify troubled loans early, prompting actions like increased monitoring or collection efforts to limit the losses. The debt to income DTI ratio compares a borrower's debt to their income, signaling repayment capacity. A high debt to income ratio, such as above 40%, indicates risk, as borrowers may struggle to pay. For example, a retail borrower with a 45% DTI, example $2,000 in debt, $4,044 income, faces strain, especially if rates rise. The banks monitor debt to income to assess the risk in mortgages, credit cards, and SME loans, adjusting the terms or limits to prevent the defaults. Payment behavior tracks whether borrowers pay on time or miss payments. It is a key risk indicator. For example, an SME missing two payments in a row signals financial distress, warranting closer scrutiny. The BIS reports 20% of retail loans missed at least one payment in 2024. This reflects economic pressures. Banks monitor this to identify the early troubles, enabling interventions like payment plans or increased contact to reduce the default risk. Stress testing. Stress testing involves simulating adverse economic scenarios such as recessions or rate hikes to assess a loan portfolio's resilience. This tool evaluates how retail loans, for example mortgages and SME loans, withstand shocks like unemployment spikes. Stress testing is required by regulators like the Basel Committee to ensure banks can survive crisis. It's a proactive way to identify the vulnerabilities and prepare for unexpected losses in credit risk management. The scenarios banks use scenarios to stress test portfolios. Examples include a 10% unemployment spike, mimicking a recession, or a 5% interest rate hike, increasing the borrowing costs. These tests assess the impacts on default rates and losses for retail and SME loans. Various regulators like the Federal Reserve and ECB mandate such tests to ensure banks hold enough capital as and when required. Scenarios help the banks plan for the worst case outcomes, strengthening risk management. Let us take an example of stress testing. Let us consider a stress test scenario. A 10% unemployment spike hits the economy. For retail loans, NPLs rise to 5% as borrowers lose jobs and default on mortgages and credit cards. For SMEs, NPLs climb to 7% with businesses closing. The bank responds by increasing the loan loss provisions and tightening lending. This example shows how stress testing reveals vulnerabilities, thus guiding the banks to prepare for crisis. Recent stress test data provides insights. The Federal Reserve's 2024 test show the US banks withstanding a severe recession with losses up to 10%. The SME loan losses rise 15% in adverse scenarios as per the BIS due to business vulnerability. The trends show banks conducting more frequent tests since COVID-19, reflecting a heightened caution. This data helps the banks assess portfolio strength and meet regulatory standards. Let us see some application of stress testing. Stress testing guides banks in planning for risk. For example, a bank boosts reserves by $10 million after a test shows high SME losses in a recession. It also adjusts lending, tightening criteria for risky borrowers. This aligns with Basel and central bank requirements, ensuring capital adequacy. Stress testing strengthens credit risk management, preparing banks for shocks in retail and SME portfolios. Portfolio monitoring tracks the risk across the bank's entire loan portfolio, ensuring that there is no hidden threats which can emerge in future. It focuses on the concentration, exposure to one sector, and diversification spreading of the risk. For retail and SME loans, monitoring prevents correlated defaults from destabilizing the bank. Regular reviews of loan performance and economic trends help the banks adjust strategies, limit losses, and maintain financial health in dynamic markets. Concentration monitoring tracks exposure to a single sector, borrower, or region. For example, if 30% of a bank's loans are in real estate, a market crash could cause major losses. Basel norms often limit exposure to 25% of Tier 1 capital per sector to reduce the risk. The banks review portfolios monthly, identifying overexposure and adjusting lending to balance the risk and protect stability. Diversification spreads the loans across borrowers, sectors, and regions to reduce the risk. For example, a bank shifts 50% real estate to 30% real estate, 30% retail, and 40% SMEs, minimizing the impact of a single sector's failure. This approach limits correlated defaults, protecting the portfolio of the banks. The banks use diversification to balance growth and safety, which is a key lesson from past crises. In 2024, some banks had 25% of loans in SMEs, nearing concentration limits as per the bank reports. The IMF notes diversification reduced NPLs by 1% from 2023 to 2025, showing its value. The recent trends indicate banks actively diversify post 2008 crisis and the COVID-19 pandemic, spreading the risk across sectors. This data drives portfolio adjustments for stability. Banks apply portfolio monitoring to manage risk. For example, a bank caps SME exposure at 20% of its portfolio to avoid concentration. Regular reviews track performance using data to shift loans to safer sectors. This ensures stability, aligns with Basel limits, and protects against losses in retail and SME lending, maintaining a balanced portfolio. The early warning systems are tools to detect credit risk signals before defaults occur. They monitor indicators like missed payments, cash flow drops, which thus alerting the banks to potential issues. For retail loans, example credit loans and SME loans, early warning systems enable proactive actions such as contacting the borrowers or adjusting the terms. This system is critical for preventing losses and managing risk effectively. Early warning systems rely on advanced tools, automated alerts for late payments, example 30 days overdue, monitoring of financial ratios like debt to income or cash flow, and artificial intelligence for real-time risk detection. These tools scan retail and SME loan data, thus flagging the issues instantly. Banks use this to stay ahead of the risk, ensuring timely intervention to protect their portfolios from defaults. Let us take an example of early warning systems. An SME's cash flow drops 20% and it misses one payment on a $50,000 loan. The early warning systems flags this as high risk, sending an alert to the bank. The bank responds by contacting the business requesting financial updates, and considering a payment plan. This example shows how early warning system detects trouble early, thus allowing the banks to act and prevent defaults in SME lending. The data underscores early warning systems value. The BIS reports 70% of banks used early warning systems in 2024, reflecting widespread adoption. Early action via early warning systems reduced the NPLs by 1.5% as per 2024 BIS data by catching the risks early. Recent trends show artificial intelligence power early warning systems are growing with real-time analytics improving detection. This data highlights the early warning systems as a key tool for credit risk management. The early warning systems prevents defaults by enabling timely action. For example, a bank restructures an SME loan after an early warning system flags missed payments and low cash flow. Thus, it helps in reducing the risk. This tool enhances monitoring, protects profitability, and aligns with proactive risk management. For retail and SME lending, the early warning systems are vital to catching the issues early and maintaining a portfolio health. With this, we conclude the session 1 covering various sectors like retail lending, SME lending, and we covered few questions like how is the credit risk measured in banking. We explored certain models like probability of default and expected loss. Then we came to know what tools and models are effective for assessment, the credit scoring, stress testing, and more. And how do banks monitor and mitigate the credit risk? And the early warning systems, collateral, and derivatives. Then we learned the lessons from the past crisis and recent data. Next, in the next session, we'll cover more, increasing our knowledge upon how the credit risk is managed and mitigated by the banks and financial markets. With this, I conclude the session 1. Thank you, everyone.